sometimes you're not comparing a stock versus another stock. Sometimes you're comparing it versus cash. So why do you do that?
Well, I'll tell you what, 2008 was a wonderful year for Dorsey, Wright Associates.
Mm-hmm.
I loved 2008. It was a killer for most people. In fact, if you looked at a normal distribution of years going back to the 20s, and you said, okay, what's here on what's 3 standard deviations below trend? What's 3 standard deviations above trend? 2008 fell right next to 1937. It was that bad. It was that bad.
Mm-hmm.
But at Dorsey Wright, it wasn't, because Dorsey Wright has what's called the dynamic asset level investing, DALI. And what it does is calculates all the whole universe of stocks and takes sectors and says, okay, where should you be? Well, in 2008, it would not allow us to own any stocks whatsoever, because the top 2 positions in 2008, whatever was in the top 2 positions, the strongest relative to the rest of them, that was your portfolio, those 2. So you couldn't, stocks, U.S. stocks and international stocks were 5 and 6. You couldn't even get down to buy them. Up here was cash. You had fixed income. You had foreign currencies, that type of thing. So we like to compare and contrast with cash, do a relative strength with cash against the stock. And if cash wins, you should be in cash with that stock.
Mm-hmm. And maybe talk a little bit about, I mean, again, a lot of this seems simple. You're writing X's and O's. You're just looking at different levels. Do you ever get to a point though where, maybe like for me in 2020 when COVID happened, I got my signal to buy, but man, that was a tough signal to follow. It was like, all this uncertainty, and I've got a follow through day in April of 2020. Uncertainty's at the highest. So do you ever have those moments where, gosh, your signal is saying this, but your brain is telling you this has to be wrong?
Well, it tells you that you're going to have a difficult row if you're buying stocks in general. You buy the S&P in general. And I want to talk about that too in the SSO. But yeah, you're going to have a rough road to go. That's why now what we do is saying, okay, we're in a bad situation. We're in a tough situation. We're going to buy stocks. Which ones should we be in? Mm-hmm. And that's where the relative strength calculation comes in to select the top 5. It's not unlike a baseball game where the pitcher, you put your best pitcher up there and he's on the mound and he's starting to throw pitches. And next thing you know, he walks 4 people, 3 home runs are hit off of him. And the coach comes out, goes up, talks. He said, Bill, this is not your day. Go back in the dugout. Bill, from the bullpen, come on out and replace him. That's exactly the way it happens.
Yeah.
So,
and you might have a great fundamental story for your stock, a great pitcher, but as you said, it's just not his day.
It's not his day. Right. And some other pitcher, it is his day. Right. But we need to know which ones come out and which ones go in. And that's where the relative strength comes in.